that oftentimes give students trouble and which should be fairly straightforward. And they also happen to be very important terms when analyzing transactions and inputting them into accounting systems. Now, whenever we analyze a transaction, oftentimes we use a tool called a T account to help us to analyze that transaction. And a T account looks simply like a letter T, like this. And it consists of three parts. Cash. What's happening to cash? Well, and they also happen to be very important terms when analyzing transactions and inputting them into accounting systems. Now, whenever we analyze a transaction, oftentimes we use a tool called a T account to help us to analyze that transaction. And a T account looks simply like a letter T, like this. And it consists of three parts. The top part shows the name of the account, and the account could be cash, accounts receivables, equipment, accounts payables, etc. The left side of the T is shown over here, and the right side over here. And those are the three parts that make up the T account. Now, the definition of the term debit means left side. So the left side of the T account is known as the debit side, the left side. The right side of the T account is known as the credit side. And that's what a debit and a credit means. Debit means the left side, credit means the right side. Now, what do we put on the debit side or the credit side? Well, we put a dollar value depending on what the transaction is that we're analyzing. And what you have to determine, and this is important, you have to determine once you evaluate that transaction, on what side are you going to put the amounts of money? Are you going to put them on the debit side or the credit side? First of all, let me say this. Some accounts go up on the debit side, some accounts come down on the debit side. Likewise, some accounts go up on the credit side and some accounts come down on the credit side. So there is no general rule that says all accounts increase on the debit side. Wrong. In order to properly determine which side you're going to put your money values on, you have to first learn that there are different types of accounts. Now, there are traditional type of accounts, and there are basically 5 of them. The first type is asset accounts. Asset accounts such as cash, accounts receivable, supplies, equipment, etc. Another type of liability account, which basically shows what the company owes, or who do you owe money to. That's a liability account. Then we have owner's capital. And owner's capital shows the paper or book value of the company to the owner who owns the company. And then there are revenue accounts and expense accounts. These are the basic types of accounts. And I've underlined the first letter in the name of each account because that's how I'm going to refer to these later on. There is another group of account called contra accounts, and I'll have more to say about these in a future video on analyzing transactions. But for now, suffice to say that any contra account has a parent account. For example, if you have a contra asset account, its parent is going to be the asset traditional account. If you have a contra revenue account, its parent account is going to be the traditional revenue account. And again, more to say about that later. Right now, what I want to say is asset accounts go up on the debit side. And you're going to have to remember this. Liability accounts go up on the credit side. owner's capital accounts go up on the credit side. Revenue accounts go up on the credit side. And expense accounts go up on the debit side. So if you know what side the account goes up on or what side the account increases on, if the account happens to be going down, then you just show the money values in the other side. For example, if you have an asset account that's increasing in value, you show the amount on the debit side, the left side. If the asset account happens to be decreasing, then you show it on the credit side. Now, you must remember these 5 accounts and on what side they increase on. To make this simpler, notice that only the asset accounts and the expense accounts go up on the debit side. So if you can remember just those 2 items, you'll know that liability, owner's capital, and revenue accounts would go up on the credit side. Knowing this, you can easily determine if an account is going up, on what side to put the amount of monies, and if the account is going down, likewise on what side to put the amount of monies. So, let's look at several transactions just to give you a feel for how to use this, using T accounts. Let's say in transaction number 1, you invested $10,000 to start a business. Well, this is a transaction, and it has to be inputted into the accounting system. So, first thing you're going to do is determine, well, what accounts are affected? Well, we're investing $10,000 in the business, so we're certainly going to use the cash account. And since we have no other activities going on at this time, the only other account we can possibly use is owner's capital. Now, let's see what's happening to cash. Did the business have any cash in it before this first transaction? The answer is no. Does the business have cash now? The answer is yes, it has $10,000 in cash. So the value in the account increased. It went from 0 to $10,000. All right? What type of account is cash? Well, we know that cash is an asset type of account, and we know that asset accounts increase on the debit side, so we're going to show the $10,000 on the left side, which by definition is the left or debit side. And we're done with that account. Now we'll go over to owner's capital. Did the business have any value before that transaction? Again, the answer is no. So what is happening to owner's capital? It's increasing. Well, owner's capital is an owner's capital account. And we know by definition owner's capital accounts increase on the credit side. So we would come over here and show $10,000 there. And we're done with that transaction. And before you leave any transaction, please add up the sum of all your debits and see if it equals the sum of all your credits. In this case, we only have one of each. So the $10,000 on the debit side equals the $10,000 on the credit side, and we're in balance. And we must always be in balance. That's why we do this comparison. Okay, let's look at another transaction. Let's look at transaction number 2. And in transaction number 2, let's say we purchased $3,000 of supplies on account. All right? First thing is, determine what accounts are going to be affected. In this case, since we're buying supplies, we know one account is going to be the supplies account. And since we're buying them on account means we're not paying for them. So we have to come up with an account that's going to keep track of how much money we owe our suppliers or our vendors. And that account is called accounts payable. Right? The accounts payable